Welcome once again to the Smart Money Dumb Money Show, and I am your host as usual, Keith Richards, and I am President and Chief Portfolio Manager of Valuetron Wealth Management, and I'm a technical analyst. And I am very happy to say that we have another technical analyst that is one of the more predominant technical analysts on the scene, especially in Canada. I am very happy to bring Greg Schnell on with me today. And we're going to talk about a lot of interesting things. Greg is a real proponent of cyclical rotation, and he does a lot of work on commodities. And he owns, and I'm going to have to use my cheat notes here, he runs a research firm called Osprey Strategic. And I will confess that I'm officially going to take a subscription to this service. And you guys know that I do all of my own proprietary work, but Greg's research is excellent. So just FYI, I think it's worth looking into for my viewing audience. And Greg also wrote one of the you guys have seen the Whatever for Dummies books, and he's written a stock charting for dummies book that it's a pretty cool thing that he's done there. So I thought you'd be interested in knowing that if you want a basics on technical analysis, Greg's written the book. So Greg, welcome to the show, and let's have a good meeting.
Hey, thanks for the introduction, Keith. Yeah, I look forward to it. This will be fun. Two techies always talking is great. So
yeah. Well, hopefully we won't bang heads too much, but I think the great thing about technical analysis is we can only expand on each other's knowledge by offering our own expertise. So I want to start off because whenever I do these interviews, I tend to ask my guests for some quick notes on what they might suggest we talk about. And one of the things, Greg, that you mentioned is that you went to the CMT meeting in New York, and you met with some bigwigs in the meeting. So I'd like to hear your thoughts on how that went.
So I've gone to the CMT meeting for the last 10 years or so, and it's, for me, I'm a technician that works out of wherever I am, and that has worked well. But one of the things that I like about the New York meeting is just getting a chance to meet a lot of the senior technicians that have written books and seen different markets over time. And examples might be Ralph Akampura, who we call the godfather of technical analysis. He actually painted the Dow on the side of his barn in Minnesota, and he's done three sides of it with the entire stock market history. But people like Ned Davis and John Bollinger of Bollinger Bands and Louise Yamada of Market Magic, and just there's no other opportunity to meet all of these people, Tom DeMark of DeMark Analytics, in one place. And this was the 50th anniversary. So it was very, very special. We went down to the New York Stock Exchange floor and had dinner down there, and met with all of these different friends. And Bob Pisani was there, and I don't know if you've seen Bob's new book, but he's got one that says shut up and keep talking, which is a reference to try to keep the show going, or shut up, we're out of time, in his ear from his director. And so anyway, so there's some great history there, but Bob Pisani was there talking about how technical analysis developed from the media side, which was another interesting presentation that I found personally very interesting. But there's a new book out written by Ralph and a few other authors, and it's about the first 50 years of technical analysis, just how difficult it was to start gaining acceptance, and now how it's a worldwide movement. Very, very interesting story. So,
that's interesting. You mentioned how Ralph is talking about how difficult it was to have technical analysis accepted. And we were talking just before we started this interview, and I said, Ralph, I met Ralph, and he actually was a major influencer in my career. I was lucky enough that back in the days in the mid 90s, when I first met Ralph Akampura, he came to Toronto, and there was just a very small group that attended a class that he was running. And that's how unpopular technical analysis was. Like literally the guy that's the guru of technical analysis, the Warren Buffett of technical analysis, came to Toronto, and like 10 of us went, and I got to go have lunch with Ralph. We had a hamburger together or something back then. And he's the guy that literally said, Keith, go take your CMT. So yeah, it was really, it's funny that he's written that book, because it was, I remember I was criticized for, and I'm sure you were too, right?
Yeah.
I think anybody was, because it was the dark art. So one of the things, actually, and speaking of criticism, you mentioned in your talking notes that relative strength, you're not as big a fanboy of relative strength studies as a lot of technical people are. And interestingly, because I won't say the name, but I've interviewed one of the guests that I've had, and he's a big fan of relative strength. So would you mind sharing your thoughts on relative strength and where it's useful?
Yeah, and maybe I could share my screen, because I wouldn't mind putting up a couple of charts. And the
Absolutely.
reason I want to help people understand how difficult it is, not that it's not valuable, but how difficult it is to do relative strength by the with sector rotation. It's really, really important that you understand that it's just as important to leave the trade as it was to stay in the trade. And one of the problems with relative strength is it's very hard to exit near the highs because you still think everything's strong. And so that can be a big issue for us. So let me just give you some examples, and probably a few people will know Joe Terranova from Fast Money. And one of the things, so this is the Katie Stockton strategy on the left, and this is Joe Terranova on the right. And I think so Katie Stockton is Fairlead Strategies founder. And so she's a big technician. And what you see here is this is her performance basically since the October lows. And the same with Joe here. And as the market's gone up, even like Joe calls his the momentum ETF. Now he's got some boundaries. But when you manage an ETF, you have some boundaries. So it's a little bit not quite as fluid as maybe they could do it on their own person. But one of the more difficult parts about this market has been that you don't get broad breadth. And with broad breadth, literally, it helps all boats rise up. And so here we have a market hitting new highs, and these, this is not quite 10%, it's maybe 5% off prior highs, but it's probably 15% off where the NASDAQ is. And so just seeing that difference is quite important. And then I think we've all heard of the Tom Dorsey, right? He did a whole bunch of stuff on relative strength, and actually he sold his company for a lot of dough to Invesco, I think was the buyer. But here's the price action of the Fortune 5, or the Dorsey Wright Focus 5. And basically they own 5 stocks that are really top outperformers, and they try to hold them. And then this is over here on the right is the 50, the Innovator IBD 50. So we all think of IBD as being relative strength, and William O'Neill, how to make money in the stock market. Like all of these famous strategies struggle a lot. And so here's the First Trust Dorsey Wright Focus 5. And really, since the middle of 2021, it hasn't done anything. Now, it didn't have the big pullback in 2022, so it did find relative strength, I guess. So you didn't lose, but you didn't gain. So in terms of outperformance, it was good. But in terms of underperformance, since the rally started, it's been trending lower since January. And then over here, you just see the IBD Innovator 50. It got caught in that big NASDAQ pull down, and then just hasn't really been able to get back under because of the narrowness of the market. And I want to make it really clear that the strategy does work. When relative outperformance is there, it's really helpful, but it's so hard to find in real time. And one of the things about Fidelity, and Dave Keller, who's with stockcharts.com, is their chief technical analyst, and you might remember John Murphy. So a lot of these people have tried different strategies, but at Fidelity, when Dave was working there, they would look for 3-month relative strength highs, 6-month relative strength highs, 12-month relative strength highs. And what is a relative strength high? So that is this purple area for me on all of my charts everywhere. Any shaded purple area is whatever chart we're looking at compared to the S&P 500. What you see here is there's definite trends. This trend's lower, and then you can draw a line under this uptrend. And for the most part, at least being aware that they're trying to make higher highs, and this I'll call it cliff drop here that happened in the middle of this chart. When you look at this is kind of how I feel about the NASDAQ right now. The NASDAQ is just on a straight up path, and it's very difficult for us to time that exit, but there will come a time, and I expect it to be a bit of a knife drop, just because we've got everybody piled into two industry groups, really software and semiconductors. So yes, we're in one sector or maybe two sectors, but I think the bigger picture with the mega caps might be, Amazon and Tesla are over in consumer discretionary, but really they're part of the technological wave that went through, where they could expand their businesses meaningfully through technology. When you look at the differences of all of those, and let's just bring up Amazon and Tesla. And what you see here is just going down to this weekly chart. So back here in 2021, when everybody was staying home, look what happened to Amazon. It literally rocketed in outperformance because everybody was getting stuff shipped to their house. That made sense. That trade came to an end, and literally you could draw a line under here when relative strength ended, and Amazon has not outperformed the S&P 500 for almost 2 years. And that's just so hard to see, because here you see a stock hitting a new high, trying to break out to a new high, and yet it's underperforming all through there. So every time this chart changes, people want to get on board, and for good reason. Now, for me, what I would do is draw a line across all of this. And if we finally saw Amazon start to break out of a new relative strength trend, that would be way more important to me than scanning for some sort of a relative strength signal. Now, in this case, it's probably hitting new 6-month relative strength highs, so that's probably not bad. A good place to look. Over here on Tesla, what you can see is it was a really strong outperformer while it was getting listed on the S&P 500. And then it went sideways for quite a while. And then actually when it started to drop off back in here, and this is a long way down, right? This is 414, this is 314. So you've got $100 in difference. Now the S&P was dropping and Tesla was dropping, so everything was coming down. But the hard part to recognize is that the relative strength game is a very tricky. It's a valuable function, but it's very hard to do well, is the point I really want to make. It's really, really hard to do well. And you need to have some, I'll call it, solid method of trying to figure out what signals you're looking for and when you take them. And I find that's one of the things that's commonly overlooked. And many people got caught in the energy trade last year, and I'll just go get XOP and OIH. And what you see here, if we go down to those same charts, is there was a really nice uptrend. Obviously, we had the spike into the Ukrainian war, where oil supplies from Russia and all that kind of stuff. And when we broke that trend line, that was a pretty important one. We pulled back, we tried to rally again, but then you draw a big long trend line under here, and this has now been underperforming for almost a year. And so many people will talk about how great the energy stocks were in 2022, but in reality, it was outperforming, but then all of a sudden Russia invaded, and then it went on a real spike, and that was the end of the story. So it's trying to time this spike end as an example of why relative strength investing is so difficult.
Okay, so and Greg, I'm going to bring you back to talk about commodities in a little bit,
Yes.
because I think we share some common beliefs about long-term cycles there. But I'm going to just change topics really quickly, because this is a topic that you and I have been ranting about breadth on my blogs. I went on BNN last week. I said, this market has no breadth. And I want to hear from your lips what you have to say about what is, in my opinion, a pretty alarming low level of breadth for looking at what the market's doing right now. And I'd like to hear your opinion on what that means to the market. So
I've got so many different ways to show it, and I try to communicate that with my clients all the time, because really it's hard to see when you see the NASDAQ going to new highs, what's going on. But here's an example. So in every week, I keep track of how many stocks are up 10%. So those are big moves. How many stocks are up 5%, down 5%, and down 10%. So this is December. And what you see in December, and the stock market fell in December, was there was a lot more selling than buying. And that goes on. Now, look what happens to start January 6th. This thing lights up. Okay, we're buying and we're buying and we're buying. And so I'm telling my clients January 6th, like we're in a big bull market, buy. Cool. We get to February and everything's looking great. And then all of a sudden this just dries up. And that's really, really odd at the start of a new bull market for this to just go from something to nothing. And so now just continue with me. So here's the month of February, and we have a couple of green stabs in here and a couple of orange stabs in here. So that's fine. We get to March 10th and March 17th. This is around when the banks were starting to fail, Silicon Valley Bank. And then March 31st, we finally have a big week of up. And then since then, we've had almost nothing. Like we've had the majority of weeks, we've had way more selling than buying. And so now we're into May. Last week or 2 weeks, last week, I guess, well, 2 weeks ago now, it would be, we had one, but it was really not that much. I mean, it was 500 stocks up 5%. So that was good. And I think the S&P was up almost 2% that week. But the majority for the last, 9 weeks, we've only had 2 up weeks in terms of outperformance. And yet the NASDAQ's gone on making it look like we're in a skyscraper market. And it's that lack of breadth, the selling underneath the surface is so big. And so I think this chart does a better job of explaining just how dramatic it is, and making sure that people are aware that, again, not just that the S&P 500 is going, I've got another chart here. I thought I had it all set up. Yeah, I did. So this is an example of over the last week, 6 days. So it takes from the Friday to the Friday. And what you'll see is, communication services and technology were up relative to the S&P 500 and everything else was down. In absolute terms, how much did they move? Discretionary was actually up, and that's because Amazon and Tesla actually went up a little bit. But you can see clear selling. Now, if I increase this to we can look at the dates up in the top left-hand corner. But if we go back to since November the 10th, it looks really positive for these 3 sectors. But it really wasn't that way. That only really started to turn on since January. So here's February. And just since February to now, almost every other sector is negative and 2 sectors are positive. So the question is that a new bull market? And what I would argue with all of my might, and Bob Farrell, who was at the meeting this year, he just mentioned you can have a bull market rising up on a few stocks, but that is not the bull market you want, because he said it's very, it's like the size of the exit is what you're worried about. And when everybody's in only the winning stocks and now they change, the move down is rapid. And so I'll give you one quick example here. And I just want to use the bullish percent index to show this. So on my chart lists, I go through all these bullish percent indexes, but here is up at the top is the S&P 500. And why we're so worried about where we're at right now, people like Keith and I, is we're right on this trend line for 14 years, since 09 to 2023. And the market is sitting on this trend line. Now, I've ignored COVID a little bit here. It wasn't an economic drop until COVID actually hit. And then the governments all flooded to make sure they stayed in power. So that was fine. But when you look at this market, this is the 02, 03 period, and see how the bullish percent index stayed low. And then you have the 08, 09 market where it stayed low. And then you have this that looks like we've literally had a tsunami. The chart's bouncing all over the place. It can't get any regularity. That to me tells me that we're not in the bull market yet. And the other thing that I'll point to is when you look down here on the stocks above the 200-day moving average, Here we are, we get way down with only 10% of the stocks above the 200-day moving average, and we start to rally out of it. When you start the bull market, so the 03 bull market, this thing went to 80 and 90%. It just soared and everything was there. And we were up there for like almost a year. It was a party and everybody could get on board. Then we came into 08, 09 and we fell, and then we tried to rally back above 50%. And that's literally when Bear Stearns happened, May the 19th or whatever. And we rolled down, and then we just struggled to try and get any sort of volume of stocks above the 200-day moving average. So the bullish percent index stayed negative, and that is taking a point and figure chart and just saying, is it on a column of ups or a column of downs? It's not quite that simple. It has to make a new low in O's or down columns in order to be not on a bull market signal. So, and then in order to get back on a bull market, it has to go all the way past the prior column of highs. So it gives you a little bit more wiggle room. But what you see is we soared all the way up to 90%, and we stayed up there for almost a year. So that was pretty valuable. What we've had here is we had the 2020, we rallied all the way up in 2021, we pulled back in 2022. All of a sudden in 2023, it looks like we're off to the races, and that was really the NASDAQ bottom, January the 6th, and we kicked off. Now, here's the problem is, since then, so this is late January, we have literally made lower highs and lower lows in relative strength for February, March, April, and May. And we're sitting here saying we're in a big bull market. Well, no, that's not how a bull market starts. This is how a bull market starts. This is how a bull market starts. This is how a bull market starts. We're sitting here in this really awkward environment where the majority of stocks are going down. We all expect the economy to get quieter. And I think I looked at the Bank of Montreal interest rates the other day. They're at 6.9%. So for a Canadian trying to hold a mortgage, if you had any variable rate or you're trying to move into a new mortgage, the rates are quite stunning. My daughters bought 2 years ago at 2.49 and 2.99 for 5 years. So these interest rates are dramatically different in terms of affordability. And I look at this chart, and S&P 500's got 44% of the stocks above the 200-day moving average. That says 56% of the stocks are in trouble. And yet we're talking about a big bull market. So I think for the people who are saying software is in a bull market, I could go with that, or technology is in a bull market. Okay, cool. Just, if you had a stool with 11 legs and you cut down all but 3, maybe 2, you're on a pretty small stool. And so that's kind of where I find the market, and that's the relative strength and the breadth that we're talking about. But the important part is right up here in this top corner. If this doesn't hold, we're in a pretty big break point like we were in 08 or in 01. And so it's that fine line, and I've got these for the NASDAQ and the New York Composite and the Toronto Stock Exchange. But what you see here is this is just like we're in a very fragile position, and to see the bull rants out there from everybody, oh, we're in a big bull market, just wake up and smell the coffee. I'm smelling the coffee, and I'm seeing that it's, on Wednesday afternoon at 3:55, I was all bullish. Just for some reason, I have my phone on do not disturb and the phone call comes in. So at 3:55 on Wednesday, stocks are breaking down, and then all of a sudden NVIDIA speaks, and we have this big, huge rally to end the week, and the NASDAQ ends positive and tech takes off. And I actually thought on Wednesday afternoon at 3 o'clock, we were probably going to be a -4% week across the board. And it literally turned like that on his comments. So are we in a thin market? I think we're in an extremely fragile one, and I hope it holds up. And again, I'd like the breadth to spread out to the rest of the market, and then I could get way more positive. But to me, all of these charts tell me, we're in a fragile state. And I've got some other examples, different ways to show this over and over. But the critical component for people to understand is this is no Hollywood movie where we're riding off into the sunset in a new bull market. We're a long way from there.
Yeah, I like what you just said. I think the key message, beyond the fact that, like you said, that the stocks on the S&P, the chart you showed a minute ago, are you're seeing, anywhere between 40 and 60% at their 200 days. That's not a widespread bull market. And so you were saying you can call it a bull market in technology, you can call it a bull market in whatever the sector that you're looking at, but you can't call it a bull market, like a broad-based bull market.
Right.
Greg, I'm an athlete. I know I'm 61 now, so I'm an old athlete, but I've been racing amateurly bicycles for most of my life, and never made the pros, just ride as an amateur, but I've been successful. And one of the things that happens in road racing is that, and if you watch something like the Tour de France where the pros are, everybody's good at one thing. So in the pros, they have sprinters, and then they have general GC guys, so general guys. And what you'd find is that if you look at a bicycle race, and this goes for any sport, but if you look at a bicycle race where it's a sprinter's course, there's not a lot of climbing. So the sprinters, who often are powerful, sort of like the tech stocks, they have just nice flat roads that they can sprint and beat everybody, because their explosive muscle fibers allow them to beat all the other guys. But in a rolling course where you need a lot of different talents all mixed up into one body, it's the GC guys, the general guys, that beat. So the sprinters are no longer any good at winning that stage. And this is what I'm looking at with the market right now. You have a one-trick pony. You have one sector that's doing all the lifting, and in their element, they're the best. But man, I'll tell you, like, it's a pretty fragile. I wouldn't personally bet on the sprinter to win the Tour de France, for example. I wouldn't put money on it, although I might enjoy that he might win on this flat stage. And I think that's the situation with this, that the market is really poised. And you said it yourself, it could be a bull market in technology, but not necessarily the other stuff. And so you can bet on technology, but you don't want to bet on the market. So anyways, carry on, Greg.
Yeah. And so I tried to create some, what I call strength indexes, to try and figure out, when the market is going to pull back, I want to be ready. And then when the market is ready to advance, I want to get back on board. And so what I did was I created these strength indexes that keep track of momentum. And so you start at the bottom, this is a nice buy point, and then it takes off to the top, and you want to stay long. And then as it starts to correct, you drop. So this is June of last year, August, December, January. And remember in January, I mentioned that the market went straight up towards February 1st and then stopped. Well, my strength indexes had already rolled over mid-January, saying, whoa, there's no horsepower here. So you compare that with this move up, and then all of a sudden we literally pulled back through February into March, and then we turned higher again. And right away, at the beginning of April, my strength indexes started to fail. Now, what's really odd this time compared to like literally 4 or 5 years of history is technology has taken off to the races, taken the indexes up with them. And my strength indexes are down here around 25%. So it's that strange to me. And I mean, I use these things religiously. Now, I will say there's one good note here, and that is that the PPO of my strength index, or the momentum curve for my strength indexes, is actually making a higher potential low here. And perhaps this technology does widen out and pull us into a big bull market. And so I get a little bit excited about that. This one, I have 3 different calculations with 3 different timelines for history. This one's actually turned onto a bull market as of Friday afternoon. So interesting. I'm very puzzled by it, but these strength indexes have really helped me stay out of trouble. And so here I've been trying to stay out of trouble for 6 weeks, and it's been a very painful staying out of trouble, because I'm watching the market expand, or the indexes expand in front of me, really the NASDAQ, not so much the S&P, but the indexes take off without me. And the main reason is because my strength indexes are saying, we're getting down to the last few stocks before it breaks down. I have one other chart that I think is really helpful for breadth, and let me just find it. Sorry about the scrolling here. It's, well, that one's a good one, but this one's pretty important to me. So what this is a chart that I have 167 charts that keep track of indexes and industry groups, and then I weight them. And so what I in this case, what I'm trying to keep track of the number of stocks that have a PPO, a weekly PPO above zero. And so you can see back here in 2019, we started off and we had a big run here where lots of stocks or indexes and industries were above zero and very few were below zero. So that's cool. So when they cross, that's a pretty important signal. So then we had COVID hit and this thing was plummeting. And so all of a sudden, none of the industry groups had stocks above the zero line, had PPOs above the zero line. Then we got the bull market and this thing was firing off. Now, even if you just got the curve right, that was cool. So then we had the September, October period and we raced up and we got into January and we took off on our new bull market. We actually fell below in early March, and then we've fallen below again this week at the beginning or at the end of May here, where we have more stocks or more industry groups with their PPO below zero than above zero. And just if you go take a big picture view of any chart, and I'll say Apple, Amazon, Tesla, all the way down to an oil company stock, whatever, just put on a weekly chart, put on a MACD or a PPO. I prefer the PPO because it helps compare history better. But when you do that, you'll just notice when the charts are below zero, it's a great place to be out of the stock. And unless they're turning up below zero, you're probably not interested. And quite frankly, once they go below zero, it's typically where they speed up to the downside. That's a really critical place. So here I have more industry groups and indexes and sub-indexes going negative this week than at any time, really since the COVID lows, since the top after 2021 coming into 2022, and we've tried the second time and failed. That makes me feel like this rally is so risky. And, maybe it's the point where my SSIs, the ones I showed you above, are right. And we're going to turn up from here. Cool. But we're at a very fragile moment. We're at about a 50-50 split. And again, I've got, different ways to show this. The chart here, I call it my heat map, but what it does is it keeps track of, if you just take the full stochastics and are you in above 80? Are you between 50 and 80? Are you between 20 and 50? Are you below 20? And so the green is above 80. Well, we hit a level this week where the yellow is now more than 50%. It's worse than any part of the bull market from 2020 all the way through to the end of 2021. This spike was in February 4th of 2022. So we're literally riding up where over so many of these industries are breaking down compared to their last 3 months. So again, I'm trying to look at it through all different angles to figure out what's going on. But this market is extremely weak. And again, we have this very small pocket up here of stocks above 80 on the full stochastic. So, or not stocks, but industry groups and stuff. When you look at that and just say, okay, we're at the narrow end of the range here. How long does this bull market roar? Well, to me, this really has to start widening out. And if it doesn't widen out, I just think we're going to accelerate lower. And literally midweek, this thing was painting a big red picture and yellow was taking off. And then all of a sudden we got the turn. And, Thursday, Friday, we had some 2% rallies and 1% rallies on the indexes. That it just brought it back to flat for the S&P. But boy, that's how fragile the market is here. And I hope people can use that breadth analogy to just understand that we're not stupid for thinking it's caution time. It's just the data's all sitting there. And the fact that the market hasn't broke is maybe, I want to say, frustrating because the data all says it should break and it hasn't. But the reality is, obviously, we'd all like the market to widen out and become a big bull market. That would make it much easier to invest. And that's what I'm looking for, but I have yet to find it. And so I really struggle with these types of things. So I've tried to display it in different ways, and hopefully that helps your viewing audience just understand why we need to be more careful here, especially based on that trend line on the big indexes of why this is such a risky spot.
Yeah, well, thanks. That does. It adds a lot of color to a very similar message I've been screaming, and very much appreciated because I think you displayed it in a better way than I do. I'm going to bring you to a final topic, but I think it's one of my favorites, and we were talking briefly about this, is the larger commodity picture. So maybe, Greg, you could bring us through both the current look of what you see on the commodity picture and what you might see on the bigger, longer term pictures. And don't be afraid, my audience is, you know, they're not in love, generally speaking, with any particular government strategy that might be going on right now. So hammer away.
I think the context I need to try and present is a large part of the world does not have energy. So they're trying to move to energy, and really the most successful economies in the world had an abundance of energy. That has been the background for the last 200-300 years. It's what made England so great when they had the Industrial Revolution and they put ships at sea, and they had methods to power these ships. And when they switched from steam to coal, that mattered. And when they switched from coal to diesel, that mattered. And all of these things were a level of efficiency better. And so we're worried about carbon, and that is a very valid method. And so what we need to try and do is figure out how to control that, and we're trying hard. But one of the major things that people that don't play the commodities a lot don't understand is that we have a reservoir. We have and I studied geophysics in school just to help people think I'm a geek. So that's squiggly lines trying to find oil in the ground. I worked in Shell Canada in their frontier exploration group for a while. Anyway, within what you're trying to find is in these squiggly lines a zone of oil or a zone of pay. And so you get a reservoir. And then you calculate how big the holes are in the reservoir and how connected the holes are. And so how your ability to get that oil out. And so let's just say that in a given reservoir, you find 1,000 barrels or 1,000,000 barrels. We'll pick 1,000,000 barrels just to say it's got some shelf life. Well, then you'll take a big basin like the Permian or the Montney or some, the Clearwater is one being discussed now in Canada. And these basins have a level of potential, and then you'll have type A wells, type B wells, and type C. So you always want to drill the A first because they're the more lucrative wells, and then level B and level C. Well, for a lot of the shale gas in the US, they're on level C wells out of a big reservoir, and they've drained these reservoirs significantly. And so in the old days, we used to drill a straight well, and then we kind of crack the ground around it, called fracking, and allow that oil to fall back to the hole. And the weight of the rock would push the oil into the hole. And then after a while, we'd put a pump jack on it to lift it up when the pressure wasn't there. Well, where we're at on now is we drill down and then we go horizontal through the same reservoir, but we can reach way out into that reservoir. But what that also means is we drain that reservoir a lot quicker than we ever have in the past. So rather than drilling 1,000 holes down, we drill 6 holes from one pad and we go out into the reservoir all different ways, and we bring all that oil back to the middle. So we've lowered our carbon footprint by making this much easier to do and cleaner to do. And when we do that, we take the natural gas and we actually use the natural gas. If you go to some of the other countries, they'll just flare that. We capture it all. But the big problem we have is if you look at a Shell or an Exxon or a lot of the big companies, nobody's interested in looking for big reservoirs anymore because the political situation is so uncertain. They're having trouble getting any project approved. And I mentioned to Keith in our talking points before, Teck Resources applied for a new mine in Canada to mine coal. It was a 90,000 page report and it got like rejected within days. So nobody wants coal and nobody wants oil, but the reality is 75% of oil's use is not transportation based. So we have this huge issue where nobody's investing, but we're still using. And we keep thinking that we're going to move to this transition of energy, electrical energy typically, but we're going to use wind and solar. And the concern there is when the wind didn't blow in Germany, the electrical rates went so high, they had to shut their industrial factories. Now, when the sun doesn't shine for so many days, and in Holland, it doesn't shine a lot. I lived there for a while. You could have the same problem where you could go weeks without getting enough sunshine to actually power up your solar. So what you've created is two very unstable sources of power. And now you need big batteries to store that. Well, we have the same problem getting mines approved for batteries as we do for coal and oil. So nobody wants it in their backyard. Nobody wants a mining shovel. Nobody wants any of this. But the problem is we all want the energy in whatever formation it is in. So we're going to need an abundance of copper, lithium, oil, natural gas. Again, oil gets broken down into plastics. Just look in your office, how many things are plastic, or in your kitchen. All of that stuff still comes from oil. So somehow we're going to get that going. Here's the problem. We've stopped funding oil. And so we've given the money, or we've told the oil companies to raise their own capital from their own cash flow to finance the next development of wells. But we're not, like the big companies like Shell are sitting over here trying to get renewable energy going, and BP is trying to get renewable energy going, and nobody is doing the exploration, in the Arctic frontier to get oil out of these vast reserves anymore. There's just no chance of getting a pipeline built, no way to get it permitted. So you just stop. So we're reaching this point where our existing reservoirs are very, very low. And then the oil that we've actually taken out of those reservoirs and put in storage tanks above ground for pipelines to connect to and move that oil around, those reservoirs are low. Then we built a strategic petroleum reserve, which was to try and deal with the price spikes that we're going to see in solar and wind, to deal with the oil price shocks we were having before. And what we did was we had the strategic petroleum reserve where we'd have a big underground cavern and we would fill it with oil. And then when price ran up, they would take oil out of that. And that's what happened during the Russian war. The strategic petroleum reserve started to get oil taken out of it. Now they haven't backfilled that. So it's at the lowest level it has been in a long time. But we don't have a strategic petroleum reserve. We don't have a lot of oil above surface, and we're not replacing the oil in the ground or the reservoirs in the ground that we used to have. And really, since 2018, this has been going on where it's been getting tighter and tighter. So, and in Canada, we're probably talking 2015, literally 8 years of trying not to get any oil development done. So you look at all of that, and yet demand is going up every day. China's demand changed last month. Their imports changed by 1 million barrels in a month. When 1.3 billion people start to want energy, it changes dramatically. So we have India and China both ramping how much oil they're importing. They're trying to get it from Iran or from Russia or from Canada or from Saudi Arabia or from whoever will sell them oil. But we're all trying to get there. And yet the problem we have is domestically, we have no new supply coming on. So it's critical to understand that we're about to go through this real squeeze. And if you thought gas lineups, just last year when all of a sudden Northeast US ran out of gasoline, that was a problem that was quickly fixed within 2 or 3 days by trucks and ships moving it around. The problem is if there's nothing to move around, then we're trying to buy it elsewhere. And we're at that crunch point. And I'm a huge fan of not trying to buy oil stocks when oil is at the top of the range. I want to buy it when it's at the bottom of the range. So I'm not trying to buy a tech stock breaking out to new 52-week highs. I want to buy XOP down here in the bottom when it starts to break out. And you can see this scooter ranking, which tells you how strong the price action is, and this is an ETF, how strong the price action is compared to all of its peers. And so compared to all the other ETFs, this spent almost 2 years at the top of the range. And now we've dropped down to the bottom. But the real point here is we're just starting construction season and driving season and airfare season, where people go on holidays, and we're increasing the volume of air conditioning we're doing around the world. So all of these factors are coming together to what I think should be a juggernaut of a second half of the year. And we're basing in here, oil's been going sideways for 4 weeks. I'm really excited about the opportunity to own this space coming into the fall. And unless we have a dramatic recession, and if we have a dramatic recession, and people are out of work, that would change how much oil we're going to use. But other than that, I really expect demand to pick up. And so I would encourage you to look at oil stocks when they're out of favor, not when they're in favor. Like, don't wait until they're up here and it looks all guns and roses and then you have a 6-month flat spot. That's not the place. You want to be down here at the bottom when nobody loves it, starting to look. And when these charts start to turn, we want to get involved. And I think we're there.
Excellent. Well, yeah, that's you took the words right out of my mouth, and you did it again more eloquently than I often do. Another point you made is all of the materials that are used to produce this so-called green energy. Well, that's got to be mined, and a lot of I did a blog recently, or maybe it was a video actually, where I talked about some of these rare earth elements. And a lot of people aren't aware that the magnets, and you mentioned this, Greg, the magnets that are used in the wind energy production units, that's large magnets are used to create that energy. Well, China has literally cornered the market there, and in production of the materials to make the magnets. And there's been some banter back and forth between Biden and China, that they're kind of using it as a bargaining chip, because of course they know that the US is on this big green movement, and most of North America is, and China holds the cards because really we haven't put the money and resources into that, in the mining of those elements. And I don't know the name of the elements that make the yeah. Whatever the case, these are things that people, I think, are not considering, is that all of these things got to come out of the ground somehow. And, whether it's demand for green or just to heat our homes, which we're not ready. Greg, I mentioned it just before the show that I was watching a particular environmental scientist, and he was saying that you couldn't actually heat a cold, if you combined all of the solar and windmills in the world, you couldn't even heat Canada, over the winter. So we're not in any way, shape, or form even close to giving up on fossil fuels. And yet to cut back on this stuff, like you say, it's obviously more political posturing than it is reality. And that's why the prices are probably going to go up. So,
well, and I need to put in one word here, because it's really important. We started to build the Trans Mountain Pipeline, and it was a $6 billion project. It recently was announced at over 30 billion. Well, it's not because people out here got stupid. It's not because people out here couldn't control cost. Literally, if a sparrow starts to nest anywhere near the pipeline, we have to wait 6 weeks until they're done. We had 50 snails on the path in the winter. We had to wait until spring for them to migrate off the path. We couldn't take a shovel and lift these snails out of the way. And so you've got crews sitting there for 6 and 8 weeks waiting for a bird to move. And then, I'm trying to be very polite when I say this, but Deerfoot Trail drives through the middle of Calgary. The Osprey nests right on a lamp pole under a road with 130,000 cars a day, and nobody cares. That's fine. He's right beside the river. That's okay. But literally trying to build the pipeline has been this big, you guys are damaging the world and we got to wait for the birds and all this kind of stuff. So if the lithium mines and the gold mines and everything we do in Canada starts to get to the point that we have to wait for birds to fly, we're just not economic. And so expecting low cost energy to be here in any form or fashion is a really difficult investment decision for people to make. So I would just say that if we are going to continue on this path of trying to stop the world so that nothing happens and we don't use any energy, I think we're going down a really tough road. So I really hope that we start to figure this out and get to a more viable solution, because if we're going to build lithium plants in Quebec with the same boundaries that we built the pipelines in Alberta, it will be unbelievably difficult to get those done with any level of financial viability.
Not to mention that the green technology isn't going to replace fossil fuels because we're simply not able to. So, but whatever the case, there's always opportunity. We can look at these things and they drive us crazy as citizens of the country or whatever. But I think there's, like you're talking about, there's opportunities abound for those of us who take advantage of. I actually wrote a blog on taking advantage of government stupidity, and I think this is one of those opportunities that you could probably make some money on idealisms that just aren't real. So
I think and just why do I think that we're ready to get involved in energy here? What I like is this natural gas, after going from whatever $10 to 2 or just under 2, is starting to get the PPO to turn up, and you could draw a trend line down here. And I like trend lines on my momentum indicators. When they break, I'm much more interested. So I'm looking at natural gas right here, and I want to start to think about having a position in here. And this might wobble around in the $2 to $2.50 range. Try not to get washed out, but when this turns, it should be another beautiful run. So that one makes me prepared. And look at the full stochastics on the price of oil here. Every time it's making a higher low, and it looks to me like we're about to turn up for the next cycle for oil. Again, we're sitting down here closer to the lows than the highs, and that's where I want to buy oil. I don't want to wait until it gets all the way back above whatever 6-month highs. I want to buy it as it's turning. And then once it gets up to the frothy levels that everybody goes, wow, look at what's going on in oil, that's probably the day you need to be trying to figure out how to sell it instead of buy it.
Contrarian investing, I love it. So all right, well, maybe Greg, we'll get you to unshare the screen, and we'll
Sure.
we'll just sort of finish up with some conclusions. And really, I think what we've heard today is that I really liked your comments on the ups and downs of and how you use the relative strength studies. I learned a lot there, and I guess we're quite on the same page when it comes to the commodity argument. I've been a commodity bull. I mean, we were in the commodities in 21, and then we moved out in early 22, more for technical reasons, but we're just tiptoeing back in again, and I have the same exact reasons that you're talking about. So awesome comments. You always like people that agree with you, right?
It makes it much easier. I don't have to argue.
Best kind of people. Yeah. So again, thank you very much. And I'm just going to mention your website. Once again, it's Osprey, which is OSPREY, strategic, STRAPEGIC.org. And you can go find out more about Greg and more about his research, which is, I must say, excellent. And I am subscribing to it. So I'm money where my mouth is. And you can learn more about Greg there. So thanks very much for coming to the show.
Thanks a lot. Thanks for the invite, Keith, and good luck.
All right. Thank you. Have a good one.